After a rough Thursday, the stock market had an even rougher Friday. On Thursday, we found out that manufacturing in the United States shrank for 4 straight months, which had investors starting to worry about a recession, and we saw the stock market fall. Then on Friday, we got more bad economic news. We got the unemployment data, which said that unemployment numbers in the United States are rising faster than expected because employers are hiring less people than expected. But it wasn't just that. We also found out that wages are growing slower than expected in America, which means if you're trying to get a raise, it might be a little bit tougher. Then we got all this news. It pulled the stock market lower. The NASDAQ entered correction territory, meaning it's about 10% off of its highs. Last month in July, the NASDAQ broke a new record high. As of now, the NASDAQ is more than 10% off of their record highs, which means it's now entering correction territory. And then Amazon came out and they gave their earnings statement. And what they said is that people don't have the same spending ability on Amazon because they saw spending fall on Amazon. Why? Maybe because inflation is starting to impact Americans' ability to spend, because they no longer can keep spending money like they could before, because now they're tapping out on credit cards and they don't have the same ability to spend. This then changed the way that people are perceiving interest rate cuts coming in 2024. Just a few days ago, people heard from the Federal Reserve Bank that maybe we'll see an interest rate cut in September. Well, now after all this skew of bad economic data, investors are now pricing in, this is Wall Street. Wall Street is now pricing in 4 interest rate cuts by the end of the year. Last week, they thought maybe we'll see a couple interest rate cuts before the end of the year. Now they're predicting 4 interest rate cuts, a whole percentage point cut of interest rates by the end of 2024. So what I want to do today is I want to talk about the unemployment numbers. I want to talk about the job numbers. I want to talk about this new data, what this means for the economy and how you can build wealth, because there's a lot of emotions out there. I know, and I want you to understand how you can build wealth and find the opportunity here. So let's jump into this. But first, a quick reminder that on August 15th, 1971, that's when the dollar was taken off of the gold standard, which changed our money forever. And because of that, on August 14th and 15th this year, 2024, I'm hosting a live investor summit. This is our biggest workshop of the year, where I'm going to be going over, number one, how our money has changed over the last 5 decades and over the last 5 years, but also number 2, how you can find new investment opportunities in today's economy when we're seeing the slowing economy, when interest rates are still high, when inflation is still around. How do you identify financial trends and how do you build wealth? This is a completely free workshop. It's virtual. All you have to do is register, and I got a link for you down in the description below. But you have to register soon because there's a limited number of people that can actually join me live. So if you'd like to join, I got the link for you down in the description. And let's jump into what's going on with the unemployment numbers, because the unemployment report that we got shows that it was the second weakest monthly job addition since the pandemic, since 2020. And that means that we now have the highest unemployment rate since 2021. Now, in the grand scheme of things, if you look back over the last 5 decades, 4.3% unemployment, it's not that big of a deal. But the reason why it's such a big deal, and the reason why so many people are getting worried about a recession now, is because the rate of which unemployment is rising. There's this rule on Wall Street called the Sahm rule. It's called SAHM, the Sahm rule. And this is going to get a little bit technical, but stick with me. I'll explain what this means. And what it says is, if you see a sudden rise in unemployment rates, how much? By 0.5% within a certain period. So if you see the unemployment numbers grow significantly in 12 months, then it predicts that a recession is going to come. And this Sahm rule has predicted every recession since the early 1970s. And now, because unemployment jumped up to 4.3%, the Sahm rule now says that we are going to see a recession. And this is why now you're starting to see more investors starting to get a little bit scared and pull some of their money out of the stock market because of this. Now, I'm not saying you should do this. I'm just telling you what's going on with this. Now, what you want to understand here is there's a lot of factors that are involved when it comes to a recession. And this is just for you to understand when it comes to headlines. But there are real risks in our economy. I mean, we've been talking about this for a long time. However, a recession previously was considered as good news in the stock market. Anytime for the last 2 years. If we saw something bad happen in the economy, the stock market rose. Now, all of a sudden, that has changed. Now, when we get bad economic news, the stock market falls. The reason why this is previously, we'll talk about previous to this week. Anytime we saw bad economic news, we saw news that unemployment is rising. We saw news that wage growth is falling. We saw news that there's some pain in the economy. The stock market would rally because people would assume that that means that the Federal Reserve Bank is going to start cutting interest rates sooner. That's going to stimulate the economy. So you had a lot of people on Wall Street hoping for bad economic news because that would then stimulate and pump more money into the stock market and make the stock market rise. Now, as of just a few days ago, that has flipped. And the reason why is because investors are realizing that if we do see bad news in the economy, that can mean more pain, which could actually drive pain into the stock market, even if we see interest rate cuts. And this is why now you have a lot more people on Wall Street predicting more interest rate cuts and more aggressive interest rate cuts, because now they're worried that this economic pain that we could see could drive more pain to the economy, and more importantly for Wall Street, more pain to the stock market. So something that you want to pay attention to. But going deeper into the job market numbers, ADP is one of the largest payroll providers in the United States. And what they reported last week is that wages are now growing at the slowest pace in 3 years. Now, this is something that I've been talking about a lot because the Federal Reserve Bank has been kind of alluding to this since 2021, that they wanted to see wage growth slow down. Now, you're going to say, well, why would anybody want to see wage growth slow down? Well, wage growth is good for employees. It's bad for the Federal Reserve Bank because in their eyes, wage growth is contributing to inflation because when you make more money, you buy more cars, you buy more stuff, and that's contributing to the inflation problem. So now the Federal Reserve Bank is looking at inflation and they're looking at the economy, and now they're saying, well, inflation doesn't seem like it's that big of a deal anymore. The economy is starting to be a bigger deal. So maybe that gives them some more fuel to start cutting interest rates. But the problem is interest rates today are historically still pretty low. And if we start cutting interest rates at a time where, people still can spend and still want to spend, that could make the inflation problem worse, because if inflation, gets worse, then how are you going to solve an inflation problem and an economic slowdown? See, that's the real concern. We know how to solve an economic slowdown. I mean, we've seen that in 2020. We saw that in 2008. We saw that in 2000. These were all economic slowdowns where inflation was not a concern. If we now enter an economic slowdown and the Federal Reserve Bank starts to cut interest rates to stimulate the economy, that could stimulate the economy, but that could make the inflation problem worse. And we know that inflation is painful because inflation disproportionately hurts consumers. That is, every single person in America. But it disproportionately benefits investors because inflation helps stock prices and it benefits real estate prices. So the investors that own those assets see their investments go up in value, versus the people that don't own stocks now have to spend more money to own some stocks. And people that don't own real estate have to spend more money to buy real estate, which makes it a little bit more difficult to build that wealth. So if unemployment rising faster than expected, we have wage growth slowing faster than expected, and we also have job hiring slowing faster than expected. And this is where now we're starting to see changes in the markets. We saw gold prices break new record highs. We're seeing more and more people buy bonds. And I mentioned this yesterday, and I want to really highlight this again today, which is that there's a lot of craziness, and the media loves selling emotion. I know this because I am in the media industry. My company, Briefs Media, is a financial media company, and I can tell you that the traditional media companies love selling emotion. They're either going to tell you that the world is going to end, that the markets are going to crash, or the markets are booming and you don't want to miss out on the opportunity. And the obvious thing is buy low, sell high, but the reality is no one can perfectly time the market. Nobody knows what's going to happen in the stock market on Monday. No one knows what's going to happen on Tuesday. No one knows what's going to happen in 2 weeks or 2 years. And this is where you have to know your strategy. It's important as an educated and savvy investor to pay attention to what's happening. You want to understand what's happening in the markets. Every savvy investor does. But you don't want to let the news dictate your decisions. You want to be financially prepared, which means you have cash to protect you, number one, against an emergency in case something were to happen in the economy. If something bad were to happen, like you lose your job, something happens to your business, you want to have cash to fall back on. But then you also want to have cash to be able to capitalize on opportunities. If you see a great investment opportunity, but you have no money to actually invest, it doesn't do you any good. And this is where you want to be prepared. That's what being prepared is. You want to have the cash put aside. I talked about this for a long time. You remember back in 2023, I would say it's not the year to finance a new truck. That's the year to get financially smart. That's why. It's so you had the extra cash. Number two is to be financially educated. Financially educated is all about how do you understand how to analyze an investment? That might mean how do you analyze an ETF or an index fund or a mutual fund? That might mean how do you analyze a stock? How do you know if a stock is undervalued or overvalued? And this is where you want to spend that time learning and building your financial education, whether that's watching YouTube videos, listening to podcasts, reading books, taking classes. There's a lot of ways to invest in your financial education, but the whole idea is now learning how to invest your money. And the third thing is to study financial trends. This is paying attention to which industries do you want to be investing in. You want to put your money into an industry where the money is going into, not where the money is leaving out of. And this is all about studying the markets. That's what studying the markets is all about. Notice how it didn't say study what's happening in the day-to-day decisions so you can make rash decisions with your money. No, that's what traders do. I don't want you to be a trader. I want you to be an investor. Traders can make a lot of money in the short term, but you can also lose all that money just as fast. It's risky. Trading is a job. It is not investing. I don't know how to trade. Everything that I talk about here is from the investment perspective. And if you want to be investing, you got to understand market crashes are a part of the process. Markets boom, markets bust. That's what they do. You want to use downturns as an opportunity to purchase more, but you don't want to use them as an opportunity to change your investment strategy. And this is where I want you to stay calm when you have crazy things happening, because really, things haven't gotten that crazy yet. I know a lot of people have already started to panic. I see the comics, I see the communities online. I mean, people panic. But panicking is not where wealth is built. Wealth is built through cutting through the noise and finding the opportunity. If you have a dollar cost average strategy, stick with it. The only thing that you should change when markets go down is you buy even more aggressively. If you're looking for individual companies, well, these are Black Friday sales when you see markets go down. And this is where you want to just make sure what is a good price point for you and know your buying strategy. See, this is what the financial education is all about. The reason why I don't give stock tips is because what's a good investment for me may or may not be a good investment for you. You got to know your own strategy. Your risk tolerance is different than mine. Your financial goals are different than mine. Your risk and investment horizon is different than me. The way you want to get paid is different than me. Most of my investments are for cash flow. Even when I invest my money in stocks or funds, I'm looking for cash flow. So if stock prices go down, well, I'm still getting my cash flow, right? You got to know what your strategy is. Everyone's strategy is different. But my goal is not to have you be a whole bunch of sheep. My goal is you to be financially educated and be a lion and create your own investment decisions based off of what's good for you, what's good for your family, and what's good for your community. You got to know what's right for you, but that starts with you investing in your own financial education and not being manipulated by the news, because guess what? Yeah, we're getting a string of bad economic news. We got the bad manufacturing data. We got a whole bunch of bad jobs data. We got bad data when it comes to wage growth. And so everybody looks at it as if the world is going to end now. But there's a lot of good things happening too. What you want to do is be able to find the opportunity. That's what successful investors do. They cut through the emotions and they find the opportunity. And that's difficult, especially in a time like today where emotions are hot and people will pressure you to do or believe a certain thing. But if you want to build wealth, that means you can't keep doing what the majority of people do. That's why I call this channel The Minority Mindset. It's not because it has anything to do with the way you look or your ethnicity. It's the mindset of thinking differently than the majority of people. And that's where the real wealth is built. So I want to remind you that as we start to see more craziness, because I can guarantee you things are going to continue to stay crazy. They're going to get crazier as we enter closer to an election, as we start to see more economic pain. If we see more wars develop overseas, things will continue to stay crazy. But what I want you to do is pay attention to what's happening, understand what's happening, and be able to find the opportunity. Yes, there are red flags in the economy. Just take a look at the debt levels, corporate debt levels that are starting to readjust. Why do you think every corporation in America is begging the Federal Reserve Bank to cut interest rates sooner rather than later? It's because they have billions of dollars of debt that are going to readjust starting in 2024, then in 2025. They don't want them to readjust at the interest rates that they are at today. They want them to readjust at lower interest rates so their debt servicing costs go down. It's the same reason why commercial landlords are begging the Federal Reserve Bank to cut interest rates. It's because they're holding onto all this debt on office buildings that are half leased and they can't absorb the higher costs. So the Federal Reserve Bank is understanding this. They know what's going on. But what I want you to do is not predict what the Federal Reserve Bank is going to do, because nobody can do that. We can understand what they're saying. That's my goal here. That's the goal of Market Briefs, which is my free financial newsletter. But at the end of the day, nobody can predict what's going to happen. All you can do is build your financial education and be prepared. That way you can win no matter what happens. I want you to win whether the markets are up or whether they're down. If they're down, you win because that's an opportunity to buy. If you up, you win because your assets are growing. If inflation is happening, you win because now your assets are going up in value. I want you to be able to win no matter what the markets are, but the only way for you to do that is for you to build your financial education and don't get caught up in the emotion. There's a lot of emotion out there. Cut through the noise. Everybody's got an opinion. You know that saying, opinions are like buttholes. I don't know if I wanted to say this. Everybody's got one. I was hesitant on saying this on YouTube, but there you go. I said it. All right. Have a good one. I'll see you tomorrow.